Today we are discussing boom and crash scalping method and its benefits. The best method to trade boom and crash is by scalping the markets. This is the process whereby you find opportunities and take short profit when trading boom and crash indices. Scalping involves taking advantages of short-term fluctuation in price movement. The reason why this is the best way to trade boom and crash is because of the high volatility of boom and crash markets. This type of strategy does not include cashing the spikes. This is because when cashing the spikes, it is a certain amount of losses that would occur in the trade before the spikes appear, and in some situation the spike would not come at the appropriate time of prediction, and that's why scalping is best because it has lower risks to higher reward ratios. But if you want to increase the reward ratio, that's when you have to increase the loss size as well. But even though scalping itself is a strategy on its own, it has to be combined with other strategy for it to be perfect, right? And you know, as a trader, you can't just enter the market without proper planning your strategy. A person like myself, when I trade, I combine other strategy together with scalping to trade boom and crash indices. This is the process where I invite indicators into the trade. Well, most traders don't like using indicators to trade. They depend on technical analysis and fundamental analysis alone, while most will say price action is best, right? But don't get me wrong on this, right? Those type of analysis are great in trading, and everyone has what works best for them. You know, what works for me may not work for you. So what I'm sharing with you in this video is the strategy that have worked for me, right? I combine indicators that is best to it, and I have a good trade, right? So what is a good trade? A good trade should be rated from 60 to 100%. A good trade always have ups and downs, and it eventually ends up being good, right? Most of my trading, I take 4 to 5 candles from the market, right? I call this scalping. I do this with a combination of indicators. So when I check the trend on the indicators and is giving a signal for an entry, I will enter the trade and take advantages of small price movement from the market to avoid spikes, right? This way my trade can be safe from many losses, and I can count my winning much more than my losses. I'm going to show you a scalping method for boom and crash that can make you profitable in your trading journey, right? So let's get started with it. So we are scalping boom 500 first, but I cannot just enter the market without proper planning. So what I would do is invite indicators into my chart so that I can use them to see a good entry or a bad entry, right? I can use any indicator of my choice. So I'm going to look for a good indicator, which is let's start with the RSI, which is the relative strength index, and the average true range. Let's use those two indicators to trade. So what I'm going to do right now is to head over to the indicator section right here and click on the main window, and firstly I'm going to impute the RSI, which is the relative strength index, while I'm going to put it on period 14 while it's applied to close right here, and the level is going to be on 10 and 80. Let's change here to 80, right? While the style is going to be on 2 pixel. Then this line should be the one with a straight one. Then I'm going to click on done. Then the time frame should be on all time frame on default, while the style is going to be on 2 pixel and on the straight line. Then the color should be on blue, but you can use any color of your choice, right? Then I'm going to click on done. So this is the RSI indicator. So I'm going to put indicator window 1 on. I want to choose the average true range right here. Then we're going to set the period on 14, while the level should be on 2. You're just going to add just one levels as 2, while the line right here on the style should be on 2 pixel. The color is blue, but you can use any color of your choice as long as you understand how the indicator work, right? So you can use any color of your choice. Then the line should be the one with a straight one, but you can use any color of your choice. But I'm just showing you the parameters which I use on the indicator of the average true range, right? Then I'm going to click on done. There's a style right here. I use 2 pixel as well. As the color, I use red, and the line is going to be this one, the first line right here, the straight line pattern. Then I'm going to click on done. So guys, this is the indicator, right? This is the average range and the relative strength index, right? So we can see that the average range right here is the one on red, while the relative strength index, this black line right here. So now let's see how we can scalp this market, right? Guys, if you see clearly that when the market spiked, right, you remember we're taking advantages of small price movement, meaning we're not catching the spikes, we're only taking the profit, right? For a sell on boom is a sell, that's what we're taking. We're not taking the buy. The buy is the spike. So you see that when there's a spike, the average true range crosses above right here. So the only time we're taking small profit from the market is above these levels, only this zone right here, which is 80. So when it gets to this 80, you take a sell, right, immediately after the spike. So when you see the spike happened, the average true range is going to cross above the level of 90. So it's only when it crossed above the level of 90, that's when you enter for a sell. Then you scalp the market, taking small price movements, right? You take advantage of small price movement from the market. Then I'm going to explain another thing on the average true range. I want you to pay attention closely to what I'm about to tell you guys right now. Okay, you see this average true range, right? If I zoom into the screen right here, you can see that this line right here, this trend line it created, is a very small trend line. Okay, so when the spike happen, it's going to cross above this level, right? Then it has to drop again before it goes up. Okay, it has to drop again before it goes up for another spike. Okay, you can see right here it dropped down before it went up again for another spike. So let's say you take a sell, immediately it crossed above this level of 80. So immediately it crossed the level of 80, you take a sell, right? Then you monitor the trend line of the average true range. Okay, you monitor the trend line of the average true range. Immediately it drops, you exit the market. That's when you're scalping. Okay, so it doesn't have to be a specific amount of candle ticks you want to take. You can take about 2, 3, 4 or 5 candle ticks from the markets. You need to monitor the trend lines of the indicators so you can exit the market quickly. So immediately the indicator drops above this level, okay, above this level of 80, remember when it crosses, it's going to give you a spike. So after that spike, you take a sell. Then when you take that sell, then you monitor the indicator. Okay, it's going to go to the right side. So immediately it drops, you exit the market, because when it goes up again, it's with a spike immediately without giving you any signal. Okay, so you see these indicators, they are different with their own advantages, right? You see the MACD is a good indicator, the average true range is a good indicator, right? So these indicators have their own levels of expertise when it comes to using indicator. They are different, so they have different benefits, right? So there's a higher indicator, there's a lower indicator which you can use. But for me, I always like using the MACD to trade because I find it that is mostly more accurate than other indicators, right? But you can also use other indicators like the market facilitation index. You can use the force index, you can use the Bulls Power Strategy, which I use most of the time, right? But you can see that right now I'm using the RSI. The RSI uses to level the trade, while the relative strength index, you can use it to enter for a buy or a sell signal. Okay, so when it crosses above the level of 90, then you place a sell. Then you monitor the trend lines. Okay, immediately if it drops, you exit, because the next time when it goes up again, it's going to give you a spike, right? You can see how it happens right here at this point. So if I go back to the history, okay, the historical trend, also you can see that right here, immediately it crossed above right here, it gives a spike. Okay, it's going to give you a spike. Immediately it drops down below the level of 80. Okay, immediately you can see right here it drops down below the level of 80, then it waits again for another spike. So when the spike is going to happen, you're not going to see a signal for that spike, right? You're not going to see the signal for the spike. But with the MACD indicator, you can see the signal for a spike. But with the average true range, you can see the signal for the spike. So the only way you can trade with the average true range is with this technical analysis that I'm showing you guys right now. Okay, when it crosses above the level of 80, it's going to give you a spike. So immediately after the spike, you place a sell. Then when it drops down below the level of 80, you exit, because the next step is going to be a spike, even though it counts few candlesticks for the market, right? So I hope you understand what I just shared with you guys on Boom, right? So let's go to Crash 500 index so that I can tell you guys how the average true range works on the Crash 500 index. Okay, so on the Crash 500 index, what we're going to be doing is placing a buy, right? So we're going to change the sell to buy. So it's going to be 2 buys. We're going to choose on the relative strength index. We're going to put on the levels, then we're going to change the sell right here to buy. Okay, we're taking buy at the 80, and at the 10 is going to be buy, right? It's going to be 2 buys. Okay, so you click on done. So right here, as you can see, there are 2 buys right here at this level of 80 and this level of 10. Okay, then right here you see that when we're only using these 2 levels, forget about these middle ones right here, they are not too accurate. So when the average range crosses the level of 80, you place a buy, not a sell, because we're not catching spikes, we're taking advantage of small price movements from the market, which is this green candlesticks, right? So when it crosses the level of 80 after the spike, okay, you take a buy, then immediately it drops down, you exit the market. Okay, you exit the market, or you can decide to take few candlesticks from the market. You can take 5 candlesticks from the market. Then when it gets to the level of 10, when it gets to this level of 10, place a buy, and you take just few candlesticks from the market. You take just few candlesticks from the market, because the spikes is going to happen immediately it goes up, right? So immediately the trend of the average true range goes up, right? Immediately it curves up, you exit, because a spike is going to happen, right? Immediately the spike is going to happen, right? So when it gets to the level of 10, you place a buy, then immediately it curves up, it spikes up, which is this red trend. Immediately it spikes up, you exit, because the spike is going to happen. Okay, then when it gets to this level of 80, you take a buy, immediately it drops down, you exit the market. Okay, so you see how profitable this strategy can be. You can use other methods for scalping. You can use price action, you can use technical analysis alone for scalp. You can use other indicators such as the market validation index, the stochastic oscillator. You can also use the MACD to scalp as well. So these are strategies that can help you on your trading journey when trading boom and crash using the scalping method, right? So you see, the scalping method is so profitable that you can always win. You can always count more of your winnings than your losses. Okay, because you're always winning, meaning you are taking some more profit from the market to avoid the spikes from catching you. But when you want to catch these spikes, a losses will always occur if you are trying to catch the spikes, right? Some losses will occur, because when you're catching the spikes, you're going to be losing a few candlesticks. For instance, right here, let's say I want to catch a spike, for example. So what I'm going to do is to place a sell. Okay, I'm going to place a sell, right? And immediately I place a sell, if I zoom in right here, if I zoom in, you can see that I'm already losing on the market. I'm already losing on the market because I want to catch a spike. So before the spike is going to happen, there's going to be some losses already on the market, right? This is where we place stop loss. We're going to place stop loss, then we'll place stop loss above, so that when this price that's moving to reach the stop loss without the spike happening, the trade is going to close automatically, because so that it's going to prevent more losses from the market. So before you catch a spike, there's going to be some losses, right? But because we're not catching the spikes, what we're doing is just taking small advantages of the markets, small profits from the market. So we're using indicators to help us do this perfectly. Right, so now that you know why scalping is best way to trade boom and crash, right? So if you find value in this video and you really enjoyed watching this video, then do it to like and subscribe to this channel, The Daily Forex. I will see you guys on the next video. Peace.